Hi everyone, I am Michelle. Welcome to this channel and thank you for being here. Before I start, please feel free to subscribe to this channel and switch on the notification button so that you will receive the up-to-date e-learning videos going forward. Imagine you're an architect. You've been hired to build a skyscraper. Would you start by telling the construction crew to just start pouring concrete? Of course not. You'd start with a blueprint. You'd look at the land, the materials, the budget, and the timeline. Today, we are going to talk about creating the most important blueprint in our profession, the audit strategy. In the next couple of minutes, we're going to move beyond just checking boxes. We're going to discuss how to design an audit strategy that is focused, efficient, and responsive to risk. So, what exactly is an audit strategy? Simply put, it's the scope, it's the timing, and it's the direction. It defines the work we will do, when we will do it, and how much evidence we need to gather. But setting this strategy isn't just a formality we have to document at the start of the engagement. It's a dynamic process. Let's break it down into 5 key phases. The very first step in setting your strategy happens long before you look at a ledger or a trial balance. It happens in the understanding phase. Auditing standards require us to understand the entity and its environment. But why? Because you cannot identify risks if you don't understand the business. When I say understand the entity, I mean several specific things. 1. Industry factors. Is the industry highly regulated? Is there new technology disrupting it? For example, auditing a fintech startup is vastly different from auditing a manufacturing plant. 2. Regulatory environment. What are the new laws? Has there been a change in tax legislation that impacts the client? 3. Nature of the entity. What are their products? Who are their customers? Are they complex? Do they have international operations? 4. Objectives and strategies. Is the company trying to grow by acquisition? Are they trying to cut costs? These strategies directly impact where misstatements might occur. If a company is under pressure to show growth, management might have an incentive to inflate revenue. So how do we gather this? We don't just read last year's file. We talk to management. We talk to the board. We talk to the IT department. We perform analytical procedures on preliminary data. Think of this phase as a diagnostic checkup. You are the doctor, and you need to understand the patient's lifestyle before you can diagnose an illness. By the end of this phase, you should have a solid map of the business landscape. This map will guide where we look for risks. Now that we understand the landscape, phase 2 is about identifying where the landmines are. This is the risk assessment. We need to ask, where can things go wrong? We identify 2 main types. Inherent risk, the susceptibility of an assertion to misstatement, assuming no related controls. For example, complex transactions are inherently riskier. Control risk, the risk that a client's internal controls won't prevent or detect a misstatement. Simultaneously, we have to set our materiality thresholds. Materiality is the heartbeat of the audit strategy. It determines the scope of our testing. We set a planning materiality, the overall amount by which the financials could be misstated and still be considered fair. But we also set performance materiality. This is a lower, more sensitive threshold. We set it lower to account for the fact that small errors, when added up, could become material. Here is the critical link. Risk and materiality are inversely related. High-risk areas, we set a lower performance materiality. We want to catch even tiny errors there. Low-risk areas, we might be able to set a higher threshold, reducing the amount of testing. This phase gives us our target. We know what we are looking for, risks, and how sensitive our instruments need to be, materiality. With our risks identified and our materiality set, we move to phase 3, scoping. This is where the strategy becomes an action plan. We have to decide what is the nature, timing, and extent of our procedures. This is essentially a decision tree. 1. Can we rely on controls? If the client has strong internal controls and we test them and find them operating effectively, we can reduce our substantive testing, the detailed checking of transactions. If controls are weak or if it's inefficient to test them, we go substantive. We go directly to the account balances and transactions. 2. IT and automated controls. We must also scope in the IT environment. If the client uses an ERP system like SAP or Oracle, we need IT auditors to test the general IT controls. If the system generates the reports and the system is secure, we can trust the data. 3. Sampling. We rarely test 100% of transactions. Our strategy must define our sampling methodology. How many items do we need to test in that high-risk area to get sufficient appropriate evidence? By the end of this phase, you should be able to look at the risk assessment and say, because risk X exists, we will respond by testing Y at point in time Z. This is the core of the strategy document. A strategy is just a theory if you don't have the right people to execute it. This brings us to phase 4, resource allocation. We have to ask 3 questions. 1. Who? Who is on the team? Do we need a specialist? If we have a complex valuation, we need a valuation expert. If we have a complex tax issue, we need a tax partner. Do we need someone with specific industry knowledge? Auditing a bank is not the same as auditing a retailer. You need a team that understands the client's language. 2. When? Timing is crucial. Can we do interim work? Perhaps we can test controls in November for a December year-end. This spreads the workload. When are the key personnel at the client available? We need to schedule around their close process. 3. Where? With remote work, this is more relevant than ever. Will this be on-site, hybrid, or fully remote? Do we need to visit inventory counts at remote warehouses? A good audit manager doesn't just assign the senior to do the cash. They assign the right skills to the right risks. If you have a high risk of fraud in revenue, you put your most experienced senior on that section, not the intern. Finally, phase 5, documentation. We've done all this thinking, we've made all these judgments. But if it's not written down, it didn't happen. The audit strategy must be documented in a memorandum. This memo isn't just for the file, it's a communication tool. It tells the team what to do. It tells the reviewer why the team made those decisions. It tells the client what we are doing and when. Your documentation should include the scope of the engagement, the materiality calculations, the significant risks identified, the planned response to those risks, the team composition and timetable. Crucially, we must communicate the strategy, or at least the significant aspects of it, to the audit committee or those charged with governance. We need to tell them, here is what we think the big risks are, and here is how we plan to check them. This builds trust and transparency. As we wrap up, I want to leave you with one final thought. An audit strategy is not a set-it-and-forget-it document. It is a living, breathing guide. If halfway through the audit we find a massive error or the client acquires a new company, we have to go back to the strategy. We have to reassess the risks, adjust the materiality, and reallocate the resources. Setting a great audit strategy requires professional judgment, skepticism, and a deep understanding of the business. It's the difference between just ticking a box and actually providing assurance. So next time you start an audit, don't just rush to the numbers. Take a step back, be the architect, build that blueprint. Thank you for your time and attention. If you found this video is useful, please feel free to subscribe this channel and share it out with your friends and colleagues. Thank you and have a great day ahead. Hi everyone,